climate change.
Yeah, we should. She got rid of it.
Because they said that they couldn't.
Hi, everyone. I hope you're feeling okay.
But it has to be really.
It's the session before lunch, so that's always a bit
This
challenging.
works.
if you want.
Okay, this works, I guess.
So I think, so Craig and I are going to discuss climate change from
Greg,
two
please.
different perspectives in terms of kind of what
Because you have.
we are seeing in the broader industry and in the sector related to how what models are being used and who are the players involved in dealing with climate change. And this actually goes back to Andre's question around, who is winning and who is losing. Talk about that as well. But just to get a sense of kind of how familiar the audience is with some of the concepts that we'll be talking about. If you could just raise your hand if I say a phrase, if it means anything to you, or if you've heard it before. If you could raise your hand, that would be great for us to get a sense of how deep or not we need to go, right? Just transition. Okay. Agricultural insurance. Great. So these some topics are better for me, some for Greg. Public-private partnerships. Okay. And climate change adaptation. Okay, so the front half of the room and the back half of the room are a bit different. So that's great. So we'll try to speak to both. Yeah. All right. So I think I will let maybe Craig get started. So we'll start on the who is losing, who is winning question and how to help those who might be losing out more. And then I'll talk a little bit more about public-private partnerships and agriculture insurance and how we are seeing this impact on smallholder farmers.
I can't think what I said. I don't know what that means. Well, it's not really true. I sit all day in front of a computer, but maybe it's easier to talk. So maybe it's more the talking than the thinking. So as you, I guess, noticed, there's a big shift from the conversations we were having before coffee to after coffee. Right. So before coffee, we were talking about mostly financial inclusion, access to finance, financial education, micro enterprises, microfinance, and so forth. And all of a sudden, we come back from the break and we're talking about climate change. That's a bit of a shock to the system. And the logic here, in case it's not clear, is what we're doing is highlighting different ways in which the financial sector can achieve different social outcomes. So the first part, the discussion around microfinance, was really around this idea of social justice in the financial markets, that people should have access to the same products regardless of their backgrounds or their socioeconomic conditions. And the credit union example and the Boost example were great as a way of talking about how those business models can work for sort of underserved market segments. So that's an exciting dimension to it. Now, after the coffee break, now we're looking at one of the most existential threats that we're facing, climate change, and recognizing that the financial sector can be a major player, both an antagonist and a protagonist, meaning that they can make things better or make things worse. Well, the other way around. Make things worse or make things better. And hopefully we want them to make things better. And in that context, I want to focus more on the ugly part in Andrea's Clint Eastwood reference, in the sense that this whole idea of ESG is an important framework for the financial sector to be able to articulate what it's contributing to environmental and social agendas. Just because we can't measure things well doesn't mean they're not important. And so I think, sort of pushing back on, it's great where things are measurable and we can put a price tag on what we're measuring and influence the business case, that's fantastic. But in practice, we also need to try to figure out how to unlock, how to unpack, how to measure things that we care about that are more difficult to measure. And so that's sort of the distinction that I want to make with what Andrea was articulating, that this S part in the ESG still is quite relevant. And I'd say you can't achieve the environmental goals that you want to achieve without taking into consideration what impact they have on workers and the communities in which they're based. And I think the question from Andre about who pays is really trying to get at this issue. So just transition. I want to ask you if you knew what it was.
Okay, go. Just needed to. Okay.
So this is a way for thinking about it. So the ILO estimates that in this transition, the transition itself, maybe this transition will create by 2030, 100 million or so green jobs, which is great. So there's a whole lot of opportunity in creating lots of jobs. And in the meantime, the transition will result in the loss of 70, 80,000 jobs from sort of carbon emitting industries and energy sources. So that's a great net outcome, right? More green jobs are created than sort of brown jobs lost. The issue, though, is that the people who are working in those brown jobs and the geographies where those brown jobs are taking place don't automatically transfer to the green jobs. So green jobs will be picked up by different people in different places than the brown jobs existed. And we need to be thinking about what then happens to the people who are in the brown jobs. What are they going to do? What are their livelihoods going to be? And in the communities in which they're operating. So if we think about this, there's sort of these three elements. Green low carbon activities. This is sort of creating the green jobs, the renewables, solar panels, and so forth. Super exciting opportunities there. It's happening now, it's happening fast. I mean, every time you pick up a newspaper or an Economist, you see new articles about new innovations that are taking place. It's super exciting. So that's super cool. Creating lots and lots of jobs. High emitting, hard to abate activities. So this is the mines, the energy, the coal, energy sources, making steel, making cement, a lot of the agriculture stuff. These are some transitions that need to take place to reduce the carbon output that a lot of sectors are contributing at the moment. And so that's an important agenda that we need to be promoting. And then the last bit is, you know what, we've already screwed up the environment pretty badly as it is. We need to rethink how we're going to enable people to adapt and build resilience in the place of erratic temperatures, global sea rises, and so forth. So what is needed for infrastructure, for agriculture, resistant seeds, and so forth. So this is sort of a general idea about the approach. The financial sector fits into all three of these. So green finance, even if Andrea doesn't want me to say green finance, so maybe with the provocation. But definitely the investing and getting the financial sector to see how it can invest in these exciting new innovations that are taking place that are helping to reduce carbon outputs. While at the same time, working with their clients who are in high emitting sectors to figure out how they're going to make this transition. And that's sort of one of the really complicated pieces, because it's not so measurable. It's really about a process. How do you engage with your clients? I'm a bank, and I've got thousands of clients, and I want my clients, because of this indirect impact of finance that Andrea mentioned. It's not just about my servers and the emissions taking place in a bank, because banks' direct carbon emissions are actually pretty small. They don't generate a lot of carbon themselves, but it's their financing and the impact their financing has through their customers that generates the output, that we need to figure out how they can facilitate and work with their customers to be able to reduce their carbon output. And so that's one of the real challenges there. And then the last one on the adaptation, certainly we want to be thinking about how we can enhance resilience, recognizing that businesses are exposed to these risks. How can we reduce their exposure to risks? And certainly elements around insurance fit into this conversation quite readily. But it's not just insurance. It was really nice to hear the example from the credit union where having savings built up is actually a critical piece for an individual, maybe even for a business, but especially for an individual resilience, and they're having a nest egg, a rainy day fund that they can rely on. So those are sort of pieces in the adaptation puzzle where financial sector can play an important role in helping individuals and businesses and households and businesses to enhance the resilience. So when we talk about this just transition, we need to be thinking about these little hexagons at the bottom, little honeycomb pieces. Or hexagons, right? It's 6 sides. Okay. I just want to make sure with all these math people, I don't so what do we need to consider? We need to consider labor rights. So if in the brown jobs, there's a union and there is decent pay and good benefits, and in the green jobs, actually, they're not unionized. They don't have collective bargaining agreements. Maybe the job security is pretty weak. So does that mean that the green jobs are better than the brown jobs, or vice versa? Right. So this is why we can't just think about what is the carbon output, but we also need to think about some other characteristics like the working conditions in those green jobs compared to the working conditions of the brown jobs. Yes, we want to get rid of those brown jobs, but we want to make sure that the green jobs that are replacing them have the same decent work characteristics that some of the brown jobs have to begin with. All right, so that's one dimension. The social employment co-benefits. So really thinking about the benefits that these businesses provide to their employees, the skills that are linked, the linkages to other businesses around. It's important that we're not just thinking about the businesses themselves, but also the communities that they're operating within, especially where a business is a dominant part of the local economy. And you see this in a lot of places, particularly related to mines and other heavy industries where there's one major employer in a particular community. And if that employer is having difficulty, it's not just the direct workers in that business, but all the indirect businesses around that are providing lunch to the workers or other procurement for the major industry that's there. Upskilling and reskilling is another key piece. So the whole idea that people are no longer going to have jobs in certain sectors means that we need to think about what else could they do. And maybe in the same place, but maybe in other geographies. And how do we facilitate the upskilling and reskilling so that that they can sort of get back into the workforce? This isn't necessarily a financial institution's responsibility. In fact, it probably isn't the responsibility of the financial institution. But what the bank needs to do when it's engaging with this worker, when it's engaging with its clients, is to go through this sort of process to help make sure that they have a plan in place for these issues. And the plan ideally would be, engaging with vocational training centers or whoever the reskilling, upskilling providers would be to help the people who are going to be unemployed to be able to get employment elsewhere with the right skills to do so. So stranded workers and communities I've alluded to already. Land and indigenous peoples' rights is another factor to keep in mind and looking through these sort of just transition plans, and then thinking about protecting against livelihood and household risks. So that's the adaptation piece that I talked about already. The financial institutions can play a really important role in providing. So the tricky part, as I've alluded to already, compared to what Andrea was talking about, is that this stuff is sort of fuzzy. It's hard to measure. And if we care about it, we need to figure out a way to show that we're making progress, that it's being achieved. And it is much more process related than outcome related. So I guess looking to the mathematicians, it would be great thinking about how maybe there might be some possible solutions to be able to come up with proxies or come up with measurements that would enable us to really promote this idea of a just transition, just in the sense we're not leaving anybody behind, which is what the slide is telling us, that this transition needs to make sure that the opportunities and the costs associated with the transition are equitably shared, right? So it's not like all the rich people get to take advantage of the opportunities. They're investing in all the green businesses. And all the poor people who were working in the brown businesses now all of a sudden don't have jobs anymore. So that would not be a just transition, right? And it's sort of a little way of articulating it. It's much more complicated than that, but just to sort of be thinking about these issues as we're moving forward. And so how do we do that? We want to be thinking both about the mitigation side. So how do we reduce carbon footprint? This is both the brown and investing in the green, but also the adaptation side. How do we make sure that those that are most exposed to the risks that are exacerbating, getting worse right now, have ways of managing those risks more effectively, and how do we reduce the likelihood that they're impacted by them? The real key here is not leaving anybody behind. So the social dimensions of a just transition, I'm going to talk about these four pieces. One is thinking about those that are directly affected by the transition. And that fits into the issues related to the reskilling, the communities where the businesses are operating and so forth. Some of these are very sector specific. And I mentioned agriculture, steel, cement, energy, transportation. These are sectors where they're going to be highly impacted. I was thinking the other day, and probably you already have thought about this already. It's like, when will we see gas stations, or what do you call them here? Petrol stations? When will we see them change? Or maybe we are already. We see them installing power, what do you call them? The electric charge for the electric cars. I don't know. It's going to be a big difference. All the people who their jobs are to fix petrol engines, are they going to be able to also fix electric engines? Well, it doesn't need so much fixing. So this is just sort of illustration of how this transition is happening, and it's going to affect lots of people doing sort of regular jobs. Just because I fix cars, or I know how to manage I have that skill to be able to fix cars, doesn't mean that it's just a regular job, right? But it's a job that's going to be affected by this transition. And how do we make sure that that worker has the right skills to go into another job where they'll be able to hopefully have the same working conditions? And that's what we're looking for, is that they're not adversely affected by this transition. A key consideration is thinking about specific vulnerable populations, women, indigenous people, youth, people with disabilities. They often, these excluded populations who aren't a part of these processes end up being left behind in the process because they're not at the table helping to make the decisions. So how do we give them voice? How do we give them an opportunity to influence this transition and think about the particular needs that they have as we move forward? And then there's certainly the place-based considerations that I've alluded to already. So I think the idea in general, why this makes sense for society, I think is fairly clear. But the question is, why should banks or even insurers get involved in this? So if you're running a bank, would you even care about this? Why would you care about it? And I think in the short run, maybe your bottom line will be better off if you don't pay so much attention to that, to be honest with you. But that's taking a very short-term perspective on things. And what hopefully, once you sort of move up in the ranks in the management hierarchy, you start taking longer and longer views of how your business is operating. And you want to, at the CEO, at the board level, you're not just thinking about the next quarterly statement, but you're thinking about 10, 20 years down the line. And there, you really do need to be thinking about the expectations on your business and how negatively it's going to be impacted if you're not doing and not facilitating a just transition. And many investors and many regulators are also coming at it this very clearly, saying that we want to see these improvements. So some banks, some investors and insurers are proactively moving in this direction and showing that they're making these contributions, which I think is a great and appreciated step. But we need to make sure that the whole industry follows along, because what happens when, I don't know, I'm not going to name, a big international bank says, we're pulling out of coal and we're going to sell, we're going to end all of our, no, we're not going to, any new requests from clients for new coal plants, we will not allow. That's great news. But that doesn't mean that another bank with maybe less social or environmental appreciation isn't going to step in and say, well, I'll finance that because that's going to still make a lot of money over the next 10 years. So there's a lot of that happening where some players with scruples are moving away from and contributing to this just transition, and others, less scrupulous financial institutions, are stepping in and replacing them. So that's not achieving the results that we need to have. And so therefore we can't just rely on scruples and good governance to achieve these results. We really need regulators to step in and have a bigger impact themselves. And I think a key piece of this is recognizing that financial institutions can't do this on their own. I mentioned in the case of the reskilling, and certainly in the case of unemployment insurance, that working with their customers is helping their customers come up with a plan, but that plan may very well mean taking advantage of government systems that need to be in place in order to facilitate this transition. And if those government programs are not available at the moment, then that's a sort of an advocacy function that we need to say, look, for this transition to work, these are the support services that we need to see in place in order for it to be effective. And just in terms of process, it is fuzzy, and the idea of financial institutions incentivizing positive change is an exciting one, because this is where we get into not just the business case for the financial institutions, but how they can incentivize their clients to make this transition. But do they do that in terms of process? They do it through social dialogue, stakeholder engagement. This is not something that you can sit in a classroom or a boardroom and come up with what the right plan is. You need to sit down and talk with the workers and other stakeholders that are being affected by this in order to come up with a plan that makes sense. And that It's logical, but that's where you get into the sort of fuzziness and process measurement that is harder to assess whether you're being effective or not. So then you want to show the results in terms of the outcomes rather than the process. So how do we measure what a just transition outcome would be? All right. So I think that's what I wanted to cover in terms of this idea of a just transition, understanding what it is, making sure that we can use the leverage of the financial system, banks, investors, insurers, to really promote the transition and making sure that that transition is just. They're not the only players in this process. There's a lot of other stakeholders involved, but they're key players because they've got a lot of money invested in these businesses, both the brown ones that are emitting lots of carbon and increasingly in the green ones that are creating new opportunities and new jobs. You want to do questions? Okay, so if you have thoughts on this issue, questions on this issue, we can have a quick conversation around possible ways of measuring a just transition, or maybe questions that you're not clear about in terms of what we mean by this. And then we'll switch gears and talk about ways in which governments are engaging with the insurance industry to try to deal with this adaptation side in terms of public-private partnerships for agriculture insurance. There was no math, there was no formulas. I've stumped you.
There is a question. Question of the remark and comment. Okay, so I have no question. I mean, I have a lot of questions, but I really don't have any answer.
Yeah.
I don't know if you have an answer.
I probably don't either.
I was thinking there are a lot of different things you mentioned, and I can't really think how a just index could be created or measured. But what I only can think of based on my very limited knowledge. So when you mentioned how people might become more vulnerable by just losing jobs in the future because of the transition. So this made me think about perhaps thinking to create a health and deprivation type index that could measure the impact of losing a job on household or personal level. Then perhaps it could be possible to quantify the impact on the mortality or morbidity level of that household or individual. Then if you could just quantify the impact, such impact on annuity prices or critical illness insurance type prices, then the insurance companies perhaps can understand what it really means for them. So it is really like a lot of different steps should be lined up. This is just how big I just see it as.
So that's a really interesting suggestion. In order to get, say, the health insurers engaged, we need to show them the potential risks that could occur amongst the populations that they're insuring and what impact that could have. That's an interesting idea. That's not going to change, say, the banks in terms of their ability to influence their customers. So it's a different dimension, but it's still an important dimension to take into consideration.
I don't know, but all I can think of. So I was just thinking, like, how can you attract the attention of an insurance company unless they don't understand how much money they could lose? So the only way to explain this to them to just show how much money they can just lose as a result of such and such, like a scenario-based analysis.
Great, thanks.
Hi, I must kind of qualify whatever I'm going to say by saying that I'm not a mathematician. So, I mean, I really like this idea of just transition, right? And somebody who works in the area of sustainable development, I find this really very useful, trying to sell this idea as actually profitable to financial institutions is a fantastic way to go. I'm just thinking that climate change actually poses less of a threat to jobs than especially urban jobs, than does artificial intelligence. I mean, you go to a petrol pump today, and the example that you used, you actually don't find anybody. There are no people anymore in petrol pumps. And this is not because of climate change. This has happened because of AI. The same thing happens if you walk into things like, corner shops after 11 o'clock, or you walk into, you can literally walk into supermarkets that have no person, just tills operating it, or even airports, and the examples are endless. However, the good thing about AI is actually it does not come with the uncertainties that climate change comes with. Climate change is associated with a lot more uncertainties, which makes just transition planning a lot more difficult. And AI has at least certainty, what sort of jobs are going to go. So planning just transition is important. So I would just say that in this dialogue of climate change and just transition, we should also include AI. And that's just going to strengthen the whole idea behind just transition and include a lot more people. And the great thing is that we can plan with a little bit more certainty. That's just a comment or a remark on whatever you're saying, but I really like this way of approaching just transition. Yeah.
Great, thanks for that. So the ILO, I don't think has come out definitively on whether AI is going to be a net creator or killer of jobs. So we'll see how that shakes out.
I mean, if you think about if you think about value added of jobs, then literally people at the bottom end of the pyramid in urban jobs are going to lose their jobs. And it is the just transition idea is much more applicable to them. So you can think if people on the top of the pyramid are losing their jobs, they have better capacity to retrain. And so if an engineer loses his job, I feel less sorry for him than if, a college dropout who's probably working at a petrol station loses his job, then that is the person who is more in need of just transition, if you see what I mean.
Yeah.
Sorry.
So thanks for that. I mean, the terminology in the ILO is shifted a little bit, and we're now sometimes talking about just transitions to include the future of work and the impact that AI has, but there isn't the body of evidence yet to give us a way forward and whether it's going to help or hurt the world of work. All right, thanks for that.
Hi, thank you. Hello. Okay. So I mean, in terms of so this is going to maybe be naive from an economic point of view because I'm not an economist, but so looking at, I mean, okay, so the thing is when it comes to climate change, like sort of these considerations, I feel like some of these changes will maybe they'll have a greater impact, possibly negative impact on third world countries in the sense that there's such a big sort of asymmetry in sort of urban workers, etc., that actually sort of will be, I think, very much affected by this. So, for instance, I mean, okay, I'm from South Africa, but in South Africa, it still is very common to see petrol attendants, etc., etc. Many individuals that do these kinds of jobs that will be affected. So that's sort of my first question is how do you sort of integrate a change like this to actually prevent third world countries that are maybe not as technologically advanced and also maybe not as maybe sort of their basic level of education isn't as high, so they are not able to sort of integrate or sort of transition to new jobs. How will you implement a change like this such that these types of countries do not get affected? So that's maybe question number one. And then question number two is that, I mean, lots of developed economies have sufficient resources to change from sort of carbon-based energy to electric-based energy, whereas lots of these sort of developing countries over the past few years, they've only started, or I shouldn't say it over the past few years, but they've more recently started using carbon-based energy than sort of other countries. They've been using it far longer because they've only just they got this technology much longer ago. So if you start penalizing the usage of carbon to these countries, third world countries will get more negatively affected because they almost have like sort of an asymmetry in terms of how much time they've had access to be using these resources. So those are my two questions. Sorry, maybe a little bit not precise enough, but I think you get the idea.
So I think the idea of sort of north-south or developing dichotomy is a really important factor in this transition process. And from a couple different dimensions, I think that on the last question, what's really interesting, so in the G20, so it's the group of 20 most developed countries, but even within the G20, there's sort of more developed countries, or sort of the G7 crowd, and then there's the rest. And in that context, and in the discussions around climate change transition, India and China in particular are always saying, we need to have more time to sort of catch up on the development side before we make this transition. And so they're pushing back their targets in order to not have to follow sort of the target timeline that the more developed countries are following, which is it's an interesting angle, is what they're saying in at the table. In practice, China in particular is just moving so much faster, and I think part of the opportunity here of not having the legacy of the infrastructure that developing countries might have is being able to leapfrog and to sort of greener technologies quicker, and not having to have in place the coal and other sort of carbon emitting energy industries as much. So I think that there's opportunities. So that's one dimension to it. The other dimension is really that the countries most affected by the impact of climate change are those least contributing to it, whether it's, islands in the Indian Ocean and Pacific, or the Caribbean and hurricanes and so forth. But certainly lots of other countries that have not historically been major emitters are the ones most affected by climate change. And that's where at the COP, they're talking a lot about this loss and damage fund, which they haven't quite figured out exactly what that means, but essentially it's a way of getting the more developed countries to pay for the losses that less developed countries are experiencing that wasn't their fault. But what that means in practice is still early days. So you're definitely hitting on this equity. And so just transition is not just about the workers and the industries, but also between countries as well.
Hi again. So just a quick comment on AI to the lady at the back. And just to say that the ILO is actually doing a lot of research, and it's really quite up to speed on I think some of the latest findings around AI. It's not the work that our team does, but I've been following the conversation. And if you're interested to know the number of jobs that will be affected, north, south, between men, women, blue collar, white collar, there's a really good paper on this that I can share with you. Sorry, I can't see the lady at the back. Top your head. Yes. But what you have to say that this topic of just transition and the impact of AI, these are two parallel topics that we are looking at. They're not competing topics. They're both kind of important and have their space. So that's just a comment for me.
All right. We'll take one more question and then we'll shift gears to the insurance side.
Okay, so for me, it is also a comment to say that we will never reach a situation whereby we will have zero carbon. That is why we are talking of the net, whereby the amount you emit, you can be able to absorb it back. And especially for us in the global south, energy poverty is real, and we cannot still yet afford these so-called green technologies as yet. So for us, because we don't have legacy infrastructure, it means that we can easily leapfrog, especially through technologies along the domains of power to X. So that is why we have a lot of harvesting of the sun, electrolysis, methane to energy, ammonia to energy. All those are technologies, if well developed, we might not need too much carbon to industrialize. However, I wanted to ask with regards to the skills part. there is a problem whereby majority of the technology is domiciled here, like in Europe, in the US and stuff like that. So when we talk green skills, especially in Africa, we are normally reduced, like if it comes to wind, we are only building the post, but then the engineering that happens in the wind vane and whatever, it is not there. So how is skills transition also linked to this just transition?
So now you're getting outside my area of expertise into the skill side, but I think that the discussion on the financing piece is hopefully that so say Rwanda or Kenya being a recipient of an investor would then make a condition that in addition to just putting your money in, that you also create local jobs or upgrade the skills of the local environment. So looking at trade and investment contracts and agreements as a way to try to incentivize or reach those outcomes that you're looking at, and asking that the investors not just take the returns on their investment out of the country, but also are leaving skilled workers in place as a result of their investment. So that would be one of the angles that the ILO would be promoting. All right.
Great, thanks, Greg. Great, so we have a few minutes before lunch, and what I want to do now, because we are a little bit short of time, is just give you a flavor for kind of what you will be hearing about after lunch in the two sessions that Lisa will be leading on inclusive insurance, and then we also have a presentation from Severin on the impact of insurance as well. But just to kind of get everyone thinking a little bit. So when Greg said the ILO was formed, we said that there were 3 constituencies that were important to the ILO. Can anyone tell me what they are? Someone who doesn't work for the ILO. So there are 3 constituencies that the ILO primarily works with. Okay, so, sorry, governments, great. We include them within governments, but yes, workers, because it's about jobs, labor, and employers as well, right? So there is, since the ILO always has had this objective of working both with the public and private sector. And what we are seeing more and more in the space of inclusive insurance, as well as in the space of climate change, is that it's not enough for either the public or the private sector to be able to deal with the impacts of the risks that we're seeing. So what's happening with climate change, as we all know, is that the frequency of the risks is increasing, as well as the magnitude of them. So a lot of regions, both in, if you want to think about developed or developing countries, are becoming uninsurable by the private sector. And the only way to insure them is actually to have some kind of government support, or actually in some cases not have people live or work in those areas at all. So that's the motivation behind public-private partnerships, especially in the context of climate change, is that much more critical now. And we see that these kind of impacts and risks are going to increase as the climate actually worsens, weather patterns change, and risks themselves become greater. So in the context of inclusive insurance, what we think of a public-private partnership, and this definition holds beyond the inclusive insurance sector, but it's a contractual agreement between a public entity and a private entity to achieve some kind of objective. Now, of course, the incentives of the public and private sector are distinct in some cases, though there is obviously a lot of alignment as well. So from the public sector, so for governments, they are interested in achieving public policy objectives, such as, say, food security, wanting to ensure that the population has access to food. There are no droughts that cause famines. There is adequate supply of grain, for example. Similarly, on the private sector, what they are looking at are their business objectives. So having access to a larger group of clients, potentially being able to sell more products, become more financially viable. But there is a common ground where essentially what you want is to have a resilient and a less vulnerable population, because that population has both better social outcomes, but also has more economic power, which is what the private sector is also looking for. So this kind of what we are trying to work with, both with governments and the private sector, is to recognize this alignment of interests, and also then to design programs where we can leverage the expertise of both those players. So at the ILO, we work a lot with governments that have, say, a national insurance scheme, and then how to kind of involve the private sector in that scheme to be able to leverage the expertise to make sure that the operation sides of the schemes are more efficient, they're more effective, there's cost efficiency, and then you're actually reaching the right clients and the right beneficiaries. So as kind of an overview, that's kind of the objective that we want to look at when we think about public-private partnerships. Now, as you can see from this graph, there are a number of stakeholders. So you have the farmer. Let's think about agricultural insurance, for example. Does anyone know what agricultural insurance is? Any of the students, maybe? Yeah.
Agricultural insurance is to protect the farmers from the weather, like the risk of the weather, and if there's something like a drought, the farmers can be supported by more funds to like supplemental irrigation, something like that.
Okay, exactly. So the idea is that if you have a risk event, it could be a drought in some cases. It can be a flood. It can be very high temperatures. There could be pests. There could be other kind of insects that can eat your crop. Any of those events is going to result in a lower production of crop. And lower production of crop means lower income for the farmers. So the idea is, how can we ensure that farmers have some kind of backup support or backup income if any of these risk events happen? And that's where the insurance component comes in. Now, with the climate change and especially with agriculture insurance, we have this concept of covariant risks. Does anyone know what covariant risks are? So typically when one farmer, say if there is a flood, it's not going to affect only one farm, right? It's going to affect all the farms that are in that region. So the magnitude, the extent of the risk is much broader than what we call idiosyncratic risks, where it's, say if there's an illness, it's possible that you are ill but your neighbor is not ill. So that's an individual risk. But with agricultural insurance, you have covariant risks, which means that the loss that is incurred by these farmers is going to be much higher. And that's another reason why you need both government's involvement as well as something called reinsurance support. And we'll talk about that a little bit more in the next session as well, I think. So essentially, anyways, coming back to the stakeholders that are involved in a public-private partnership. So you have your farmer, who is your end beneficiary. You will have government. So this could be Ministry of Finance, Ministry of Agriculture, Ministry of Health, any ministry that is interested in that public policy objective that we're talking about. You will have your NGOs and development agencies that are trying to support this vulnerable population by providing either financial or non-financial services that will also be kind of bundled with agriculture insurance. And then you have investors and lenders. So we've talked a lot about MFIs and banks that work with these populations. And then you have, of course, since we talk about insurance, your private insurance industry, reinsurers that could be either domestic or international. And input providers is an interesting angle as well, because what happens in agricultural insurance is that you're not only trying to provide protection against risks, but you also are trying to enhance production. So if you think about a farmer, for example, and if they know that, okay, you know what, I have coverage. If I do lose my crop, I'm going to get some money back, which I can then use for my next harvest. Maybe I might invest more this year. So I might buy more expensive seeds. I might buy more fertilizers. I might buy seeds that are maybe more risky, but will have a higher return. So your production, what we call production decisions, can also be impacted by having some kind of protection. So your input providers are, you can think of them as seed providers or companies that sell fertilizers. They also have an incentive in ensuring that this farmer population is better insured. Okay, so those are kind of, so you can see that any public-private partnership has the potential of sort of involving at least, say, 6 to 7 different types of entities. And hence there is a lot of, how do I say, structure and thought that needs to go behind planning and executing on these partnerships. I've kind of already talked about the advantages, but maybe just to kind of reinforce the motivation behind these public-private partnerships. So at the overall level, what we're looking at is thinking of ways that we can pool the resources of the public and private sector and use them in an innovative way and leverage the expertise that both the sectors bring. So for example, the private sector, so think of an insurance company or think of MFI, they might have kind of say more direct contact with the farmers, especially MFIs they will know the farmers pretty well. They might have a relationship with them. An insurer might have better digital systems where they can track premium payments, they can track claims, they can reimburse payments. So hence thinking about, okay, what kind of skill or expertise each of these entities brings to the table, and how can we structure this partnership to ensure that we leverage those at the maximum. And that's the entire kind of motivation behind bringing in both public and private players. For the public sector, as I said, kind of the main objective that agricultural insurance can help is to achieve kind of a public policy objective around food security. But we can think about these PPPs beyond the space of agriculture, right? So say if you have a health insurance scheme, then what you're trying to ensure is have the private sector involved in the scheme and ensuring that your overall health outcomes and well-being of your population is better. So the different schemes will have different public policy objectives that they can help achieve. Then another kind of big advantage of structuring an insurance mechanism for the government is to have more financial control and planning. So if you think about, for example, say a typhoon that hits in an island in the Philippines, it is usually the role of the government to kind of invest in any kind of reconstruction, making sure the infrastructure is back online, helping people relocate, maybe giving them some subsistence and bringing them back. So there are a lot of costs involved in that, but it's unpredictable at this point. And you don't know what the magnitude of the typhoon will be. So with using and this, I think hopefully we'll probably touch on this a little bit more later on. So I don't want to go into too much detail. But the idea with an insurance mechanism is that you can transfer some of that risk and some of that cost to the private sector. So now the insurer is going to be responsible for the bulk of those payments based on kind of what the insurance contract is that you have designed. And what the government is only paying at that point is the upfront premium. Yeah, okay. All right, and so let's talk about the private sector. So what is their motivation behind entering into this kind of partnership? One is, of course, getting access to a much larger pool of potential policy holders. Because of course, when a government is involved, the scale of these schemes is going to be much higher. And hopefully what they're looking at is also the ability to actually perhaps bundle or sell other insurance products in addition to the one that is part of the public-private partnership. And eventually what they're looking at is hoping to support the development of an insurance culture within the population, because they are looking at these beneficiaries and members as future clients as well. Yeah. So I'll just maybe talk about one example of a project that we are involved in Rwanda. Is there anyone from Rwanda in the audience? Online, okay, great. So maybe they can correct me if there's anything incorrect that I say that's incorrect. So this was a scheme that was started by the Ministry of Agriculture. It's called Minagri in Rwanda in 2019. And what they wanted to do was provide some kind of agriculture insurance to farmers and also to livestock holders or livestock farmers. So they provided two types of products. One was crop insurance and one was livestock insurance. And the way the reason for kind of this scheme was that I think about 70% or so of the population is dependent on agriculture to some extent. And hence, they wanted to ensure that there is some protection against the risks that this population was facing. So the government agreed to fund 40% of the premium. So they subsidized the cost of the insurance product for farmers, but farmers were still responsible for paying for 60% of the premium. There are, as I was mentioning in public-private partnerships, there are a range of stakeholders in place. So these are some examples here. So the scheme was originally the concept and the design was done jointly by the Ministry of Agriculture, Ministry of Finance, and Access to Finance Rwanda, which is like a think tank and kind of NGO that supports the financial sector and the government in Rwanda. So they were responsible for, laying down the operational principles, the procedures, and kind of just designing the guidelines and modalities of the scheme. They also kind of responsible for project management and implementation of the scheme and kind of measuring and assessing the risks that are being faced and the strategies behind any kind of redesign or any new crops that need to be included in the scheme will all be decided by the two ministries. Then you have the insurance regulator, which is the National Bank of Rwanda, who is responsible for approving any of the products that are part of the scheme. So one of our partners that we are working with is a private insurance company, is trying to actually introduce two new crops that they want to include in the scheme, which would be like tea and coffee. So it would be the National Bank of Rwanda that would finally agree or not whether these crops are also included and the definition of the thing. Okay, I'm getting the time call, so I think we should move quickly. And then, as I said, the insurance companies are usually responsible for the operations. So they will be responsible for collecting the premiums, for assessing the claims, making the claims pay out. They partnered with other distributors, so like MFIs, dairy cooperatives, who are responsible for actually selling the product and educating the farmers. And then finally, I said we already have Access to Finance Rwanda, which is a think tank that works and supports both the public and private institutions. So this was just, I think, can end the session here, and then maybe just give a minute or two in case you have any questions before we close. But the idea here was just to give you a flavor for the type of public-private partnerships that we are seeing in this space to tackle the impacts of climate change. And we just talked about agricultural insurance, but this concept you can actually apply to other risks as well. So you can even think about a scheme for urban dwellers who are maybe living close to a water body that floods. So there can be a national or a state level scheme also that could actually be designed to support and with the help of private sectors to ensure that you can give them some protection against these growing risks. Any questions before we break for lunch? It's all when you ask a question like that, you ensure that there are no questions. There is one part.
Thank you very much for the work. It's fascinating. I like it very much. I have a question regarding the MFI. If I understand, how is it done? If a farmer goes to the MFI, for example, for a loan, and then the MFI would then propose an insurance product for maybe the crops. Is that how it's done?
Yes, so the modality can vary based on the scheme. I think in Rwanda, actually, it's bundled both. You can have the option of bundling it with a loan, but it's also bundled with input providers. So also with, I think seeds or fertilizers, I'm not sure exactly which input. But there is, so in this case, the MFI is the one who is responsible for educating the farmers and enrolling them into the scheme.
Okay, so then you mentioned the scale. So would you do sometime a kind of community insurance? Because if it hits one, it's metting. Do you put them in cooperatives so that to mitigate somehow?
So in this case, the cooperatives are responsible for educating their members, but the enrollment is done at the member level.
Now the last one, maybe. Given the fact that with this climate change, I remember when I grew up, my grandmother would just say, "Okay, I know this is the time to put the seed now,
Yeah.
right?" And I went home there like, now we don't even know when to put the seed. If I take, for example, the maize, I used to be I know we usually harvest in June, but now it takes a big change. And what I'm interested in is that, unfortunately, in many of these countries, we do not have actual data to do some prediction. If I'm just looking at the rainfall. So how do you maybe take care of this kind of risk? Because I think it's a big problem where you also need to know, because sometimes you have the seed, and if you do not actually have the right period, then might be pointless to just work.
No, I
don't
think,
know.
I mean, you've hit the coffin, the nail in the coffin.
Coffee, yeah.
Coffin, yeah. But no, I'm not an agronomist, but this is exactly the problem, is that the weather patterns are changing themselves. So even for an insurer who's trying to design that product, say previously you would say that if my harvest period is this, if it rains like 10 days before the harvest, the crop is ruined. I'm just giving you an example. So then you would say, okay, the 10 days before the predicted harvest time is what is the insured period.
Okay.
But now it can actually, I mean, you can have like 2 rains, or maybe it's like delayed and the harvest period itself is delayed. So then that time period changes. So it's very difficult also to design the model for the product to ensure that you are actually covering the risks appropriately, because the risks are changing as well.
Okay, thank you. Never we talk of. Thank you very much.
Oh. Thank you. Thank you. Thank you.
So we are now going for lunch in the Material Innovation Factory.